drop a like and do share. Leave your comments and do not forget to subscribe for more videos.
What's up, guys? This is Manoj Uptani. I welcome you all on behalf of the Edipedia world. It's been a wonderful day outside, and I'm sure that you guys must be enjoying your life and your surroundings to the fullest. Like as usual, guys. Perfect. So, guys, we have been discussing a few of the relevant topics relating to the chapter of capital budgeting. By now, we have already completed 4 of our video presentations solely dedicating to the theoretical kind of concepts which will help you in understanding the kind of concepts and the kind of questions usually are being asked in the CA final examinations. This is the last video presentation in which I'm going to discuss with you some of the remaining and even the most important topics relating towards the chapter of capital budgeting. This is going to be the last video presentation which will be solely dedicated towards the theoretical concepts. Post this video presentation, I'll start and I'll mark the beginning of the kind of questions that are being usually asked in CA final examinations with relation to the chapter of capital budgeting. So your wait is about to get over. All you need to do is just revise the kind of concepts that I've already discussed with you guys, the concepts which I've already made you understand, including this video presentation, and then we'll kickstart the questions from the next presentation onwards. Are you guys all set for the same? Perfect. Fasten up your seatbelts. We're about to take off with the first topic of the day, and that will be sensitivity analysis. Okay, so guys, how I should make you understand this topic? Okay, how many of you guys actually watch cricket? Absolutely. Like, we belong to a nation where cricket is being treated as a religion. Okay, so everybody, like, most likely there is 90% of the chances are that we all are cricket fans. Absolutely. So think about a situation that I have lined up the entire Indian cricket team for you guys. Okay, and now if I ask you up, okay, which is that person which is gonna change the fate of the scoreboard? Okay, most likely people are gonna tell me up, okay, that Virendra Sehwag, if I'll talk about the previous times, maybe Virendra Sehwag or Sachin Tendulkar or Saurav Ganguly would have changed the fate of the scoreboard. Perfect. Now let's talk about the bowler side. Okay, how likely is it a chance that Zahir Khan is gonna be batting, and there will be a chance wherein everything is gonna be superb with that scoreboard? There is least likely possibility, okay, that a bowler is definitely going to get big on shots. Okay, now similar is the kind of state with sensitivity analysis as well. If I'll talk about today's scenario, be it Mahendra Singh Dhoni, be it Virat Kohli, okay, these are the persons on which the cricket teams and the scoreboard is immensely depending upon. Okay, now if I'll talk about the sensitivity analysis, okay, back to the kind of finance based topic, why I created an example of cricket over here was this. Finance, if I'll talk about, and I'll talk about sensitivity analysis, okay, it basically speaks out about a few of the things. Okay, that is, what's the most important thing in your income statement? Your sale, your revenue, then your variable cost, then your other cost, then operating cost, and all these things. Okay, this thing basically asks you up that which is that one factor. Okay, and if it's being changed, that one factor is being changed, how likely is it the effect that your net present value is gonna be changed with that change in that one particular factor? How likely is it a chance that if Virat Kohli doesn't perform in a particular match, India is gonna fail while while chasing the target, or is gonna win the game? Exactly is the same case with sensitivity analysis as well. It is that one process where the impact of each key variable upon net present value is studied, okay, and only one at a time, keeping other variables as constant. Okay, let's suppose I say that my sale is, let's suppose, 1000 rupees currently, and my NPV is 100. Now, if I'll talk about a situation wherein I tell you guys that if in case my sale is getting dropped by 10%, what's gonna happen? That sale of 1000 is now be gonna changing to 900. So what impact will it create on my net present value of 100, which was earlier 100? Now what will be my new NPV if in case my sale is gonna be dropping by 10%? This is something which will relate to sensitivity analysis. Each factor gets disturbed or increased with a particular percentage. Okay, what will be its decision making and how it's going to be impacting the net present value, that is being understood in this particular concept. Okay, NPV of all the projects are calculated out of the estimates of cash flows that are invariably derived from the forecast of other primarily variables such as the project life, be it your salvage value, be it your production cost, be it your variable cost, each and everything. So this particular process is where each key variable is basically deeply studied upon and only one at a time, keeping all the other variables as constant to just to see what kind of impact does it create on that NPV. Okay, that is what is being done in sensitivity analysis. And guys, this sensitivity analysis is basically like very useful. Okay, in identifying the crucial variables that could contribute to the most of the riskiness of an investment. A variable may be itself like having a large kind of variance. Okay, it might be a possibility that one is like having greater amount of risk, very great, okay, relative to other variables, but it may not contribute to the riskiness of the overall project's NPV. What if I say that if in case I take up a project, okay, and the riskiness of investing in that project is like huge. However, if I talk about the overall portfolio, then it's not going to hurt me much. Why? Because the kind of initial investment that I'll be making on that project is quite meager, okay, or quite small. That's quite inexpensive for me. That's quite nominal for me. So should I go about choosing up that project? Absolutely, I can. Why? Because I'm not investing much on it, taking care of the overall riskiness of that project. So sensitivity analysis is something wherein you'll get to understand, guys, that how we should take up a project, keeping in mind the kind of various factors that are going to affect whether we should take it or not. So that's how it's being done overall. And in such a case, that investment decision does not crucially depend on the accuracy of your estimate. Okay, and there might be a chance wherein I say that let's suppose a very less risky kind of a variable is there, okay, and it may be very crucial, okay, for making the significant impact on NPV. Why? Because I'm going to invest much of the amount for that particular investment. Okay, however, I know that that particular investment is going to attract a smaller amount of risk, but still it's very crucial for me. Why? Because I'm going to invest a lot of money on that particular investment. So sensitivity analysis is basically the one which is going to help the project manager in finding these crucial variables. Okay, be it sales, be it your change in variable cost, change in operating cost, change in let's see overall investment, change in working capital, all these things. I'm just telling you some of the examples. Okay, this is how it is being done in sensitivity analysis. Now, moving on to the kind of analysis, if I'll talk about these, are basically three major. Number one, partial sensitivity analysis. Number two, best and worst case analysis. Number three, Monte Carlo sensitivity analysis. What we usually do in partial sensitivity analysis, guys, is I basically take up one particular variable, okay, at a time, okay, and we change that variable. Be it, let's say, if there is a change in sale by, let's say, 10%. So I'll keep all the other factors as constant, okay. I won't be changing them up. I'll be changing just the sale amount, okay, by that particular percentage, okay. And I'll see like what kind of impact it is gonna create on the net present value. If I'll talk about the net benefit change, what is the change that will happen to the overall net present value if I'll talk about the change in that particular sale amount, okay. And this is basically this can be done by two approaches, okay, guys. Number one approach, you can simply go ahead while you can keep one variable, okay, as fluctuating one, be it you're changing with 10%, 20%, 30%, anywhere around, and you can all keep other variables as constant, and there is no change at all in those constant ones, okay. This is one approach which you can follow. Number two, you can do is you can simply mark the outcome, that is the benefit, that is the net present value, as zero, okay. Now it's basically a kind of retrospective approach. Okay, you're gonna reach to the final destination. Your final destination is a zero. Okay, now I am having a sale of, let's say, 1,000 rupees. Okay, what is the best suitable percentage if I need to have wherein my NPV would get zero? Now I can track out back to the game. Okay, I can simply have that retrospective effect going on, and I can get the kind of percentage wherein, if in case that percentage is being applied to the amount of sale with that change, then my NPV, that is my net present value, is going to be zero. So this is the approach number two. You can follow any of them. Okay, this is something which is being done in partial sensitivity analysis. Moving on to the second one, that is the best and worst case analysis. Next came the best and worst case analysis. Okay, guys, in this particular approach, what we do is we simply go ahead while keeping and selecting the best one. Okay, the best case and the worst case. Okay, and then we simply go ahead with that discrete kind of scenario. Okay, wherein we usually study, okay, what is the change, what is the effect of that change in one variable gets onto that final outcome, and we keep all other variables as constant. Okay, and this kind of situation is usually being applied only in selected scenarios. Okay, this is something which we don't do with each and every random kind of analysis. Okay, only and only after getting the best and the worst case, we go ahead while keeping all the other factors constant and changing that particular variable itself. That is something which is being done in best and worst case analysis. Finally, coming on to the third part, that is the Monte Carlo sensitivity analysis. What we usually do here is we basically get into while creating the distribution table. Okay, we create a distribution table of the kind of net benefit, the net present value that we'll be receiving from different kind of projects. Okay, we usually apply here the various assumptions. Okay, assumption from the kind of probability distribution that we take up. Okay, we'll be using the variance, we'll be using the mean, we'll be using the standard deviation, and after applying all these variables, different kind of things, okay, we finally get which project should be opted out for, if I'll talk about, and what will be the change if I'll talk about the effect of that particular change in particular one variable. What will be the change with that particular project? This is something which is being done in Monte Carlo sensitivity analysis. Most likely, if in case I've talked about the kind of past trends that I see, Monte Carlo sensitivity analysis is something which is usually being asked in costing, your advanced management accounting subject. Okay, wherein there is one certain part which is operations research. They are usually Monte Carlo and sensitivity analysis is regularly being asked. If I talk about something related to my subject, that is strategic financial management, here, most likely you'll get a chance that 90% of the questions, if I'll talk about the sensitivity analysis topic, then partial sensitivity analysis is the hot favorite topic of the English examiner. Okay, and they usually ask sensitivity analysis based questions out of this particular area itself. Okay, so we are going to be discussing like n number of questions in my forthcoming videos relating to sensitivity analysis. But having said that, don't allow you guys to go ahead with this particular topic before getting and understanding that well with a example. So yes guys, I have incorporated one example for you all in order to make you understand this particular concept here itself in this particular presentation, so that you can revise the overall idea, so that we can proceed towards the forthcoming questions as well. So you don't need to worry about it. Okay, I am there to take care of you guys. My next topic will be the example for it, and that will be assume that a company has estimated the following variables. Number one, sale of 10,000 units per year at rupees 5 per unit. Number two, variable cost per unit is 3, fixed costs are 5,000 per year. Project has no salvage value, project life is 3 years. Project cost is going to be 21,000, depreciation in as 7,000 per year. Project is financed with retained earnings. Number 4, investment in net working capital is 10,000. The net working capital investment occurs at the beginning of the project, and it is assumed that all the net working capital is converted into cash at the end of the project. Fifth, the firm's required rate of return is 20%, that is the expectation, and the tax rate is going to be 34%. Perform the sensitivity analysis of the company's base case for the 10% change in price. Now, what we got here, we have simply got the final thing, which is we need to perform the sensitivity analysis for the base case, that is 10% change in the price. Okay, how should we proceed while doing such kind of question in examination? Let's see. This is the kind of presentation that I want to deliver to you guys in order to make you understand this concept pretty well. Number one, we did heard that the sale is of 10,000 units per year. So I can simply say 10,000 per year into 5. It's gonna be the sale for me for that complete year as 50,000 rupees. If I talk about the variable cost, it's gonna be 3 rupees. 3 into 10,000, it's gonna be 30,000 rupees. I'm still left with 20,000 rupees. Out of the day that I am gonna be deducting my fixed cost, that is 5,000 rupees. Project has no salvage value at all. Okay. So fixed cost 5,000 rupees. Then again, there is a depreciation each year. Depreciation total is of 21,000. Project life is for 3,000. So technically, my depreciation for each year is gonna be 7,000 rupees. I'm still left with 8,000 rupees as my earning before interest and taxes. I'm gonna pay my taxes, that is 34%, that is 2720. I'm still left with my net income in as 5,280 rupees. Now, if I'll talk about something relating to operating cash flow, so I will simply add back the depreciation because depreciation is a non-cash flow deducting item. Okay, my cash is just not going anywhere else. Okay, so I'm gonna add back my depreciation to my earning before interest and taxes. So that will be 8,000 plus 7,000, and out of the same I'm gonna deduct my taxes amount. So that will be 2,720. It's gonna be finally rupees 12,280 rupees. This is one particular scenario. Another one could have been I would have like simply added net income with that amount of depreciation. I would have got 12,280 rupees, but this is a better one. So EBIT plus depreciation minus taxes, you get rupees 12,280 rupees. Now coming to the calculation part with relation to the cash flow. Okay, my operating cash flow for each of the year that I'll be getting for year 1 is 12,280. Again for the same next year, again the same for next year, that is my third year, it's gonna be the same. Now talking about the net working capital, we just heard here itself in the example that my investment in net working capital is gonna be rupees 10,000, and this is something which will occur at the beginning of the project, and it will be assumed that all the net working capital is going to be converted back into cash at the end of the project. So what's going to happen in my initial first year, that is my zero date of project, I'll be having a deduction of 10,000 rupees in my net working capital, and at the end of the period, that is the third year, again I'll be able to recollect that 10,000 rupees back in my kitty. So less 10,000 in year 0 and plus 10,000 in year 3. And the capital spending that I'll be using up over here is the project cost, that is given as rupees 21,000. So this is gonna be included in my zero date of project. Okay, less 21,000. So my total spending in this year 0 is gonna be 31,000, and I'm gonna get rupees 12,280 for year 1, 12,280 for year 2, and 22,280 rupees for year 3. So is it a valuable kind of a project for me to invest in? Absolutely, because the NPV is positive. So I can simply go ahead with it with this particular project. That's gonna be sure. Now moving into the second part. Okay, whether I should go ahead if in case there is some certain percentage change in this particular question or not. So NPV I can say get with my 12,280 divided by 1.2, that is my required rate of return 20%. I'll be dividing 12,280 rupees from that. I'll be adding 12,280 rupees for year 2, dividing 1.2 to the power 2 for year 2, and finally 22,280 divided by 1.2 to the power 3 I'll get the kind of overall cash flow with it, how much I'll be like able to recover from this investment, and out of the same, I'll be deducting my initial investment that was 31,000. I'll get the positive NPV of rupees 655. This is the common scenario, the normal scenario. Now, moving on to the second part, that is my sensitivity analysis. If in case guys, my price falls by 10%, then my price is gonna be 4.5 per unit. Okay, initially it was 5. If in case the price falls by 10%, the revised price would be 4.5 per unit. If in case I keep other variables as same, what's gonna be changing? Only and only my sale amount. Earlier my sale amount was 50,000, now it's gonna be 45,000. Out of the same, I'll be deducting my variable cost, my fixed cost, and my depreciation. I'll be able to get a figure of earning before interest and taxes. Out of the same, I'll be deducting my taxes, that is 34%, that is 1,020 rupees. I'll get the net income as 1,980 rupees. In order to get the operating cash flow, I'll be adding depreciation to it, and it will be amounting finally in as rupees 8,980 rupees. Now, while applying the same thing to this project as well, so I'll get the operating cash flow for all the 3 years as 8,980 rupees. Keeping the things as same like the earlier case, net working capital will remain minus 10,000 in year 0 and plus 10,000 in year 3. Capital spending, my project cost would be rupees 21,000 in year 0. So my overall cash outflow in year 0 will be minus 31,000, and I'll be able to recover amount of 8,981 year 1, 8,980 in year 2, and I would like to apologize to you guys, in year 3 it would be 18,980 rupees rather than 8,980. So erroneously one has been like missing in this particular figure, though the NPV is gonna be the clear case here itself. NPV calculation is absolutely correct. So that will be 8,980 divided by 1.2 in year 1, 8,980 divided by 1.2 to the power 2, plus it would be 18,000 and not 8,980 over here. So my mistake for that particular matter. That will be divided by 1.2 to the power 3, and out of the same I'll be deducting my initial investment of 31,000. I'll get a NPV negative of rupees 6,297. So the fall in NPV, if I'll talk about, is primarily minus 1061% over here. So earlier it was 655, now it's minus 6297. I'll be adding 655 to it, I'll get a figure of 6952. Dividing 655 to it, I'll get a figure of 1061%. So the interpretation is, if in case my price decreases by 10%, and if in case I keep all the things as equal, my net present value would decrease by 1061%. And that is how sensitivity analysis actually works, guys. I hope I was able to deliver you completely with a great example in order to make you understand how we should proceed if in case we get a question relating to sensitivity analysis in our examination paper. Are we guys clear with that? Perfect, guys. Shall we proceed further? Let's go ahead with the last topic of the day, and that will be simulation analysis. So guys, have you heard about this term as financial models? Okay. There are many people who have got into this hot job of financial modeling. Okay. What these guys basically do, okay. I am a person, I'm like having like, let's say 1000 crore rupees. Okay. Let's suppose, okay, let's assume that I am having 1000 crore rupees. Okay. There is a possibility that I want to invest in some kind of good project. Okay. However, I don't have that much knowledge with me. Okay. I'm a bit short of that accurate kind of awareness that I should have. What I'll do is I'll better approach a kind of firm wherein those guys will be like specialized, and those guys will be like having good amount of knowledge where I should invest in if I'll talk about some of the relevant and great projects for myself. What they'll do is they'll simply add my money to their different kind of projects. Okay, wherever whatever kind of projects do they have. Okay, They'll run their computers accordingly. They'll start into financial modeling and they'll get the best kind of opportunity for me on board. Okay. Financial modeling, if I'll talk about, and I'll talk about something relating to simulation analysis. Simulation is something which usually basically helps you up in understanding if in case I get this particular data and if in case I apply this particular data in an actual kind of situation, then what is gonna be the result? Okay, this is something which will be like created in simulation. Have you ever heard about this thing that once the Apple releases its product, okay, they basically form its prototype first of all, okay. Only after the clearance of that prototype, finally the sale gets started with any kind of Apple iPhone, okay. This is something very normal with any Apple iPhone, be it Apple 6, be it 6s, be it 7, any one, okay. Simulation is nothing but it's a simply analytical method which is meant to imitate a real life system, something which has not happened. However, if in case that will be happening, that's going to be the very same thing which has already happened in that prototype, okay, or that simulation. Simulation is a process which calculates the multiple scenarios of a model by repeatedly sampling the values, different values, be it your sales, be it your variable cost, be it your operating cost, be it your production cost, any other things, okay, from that probability distribution, okay. If in case my sale is gonna be like 1000 rupees, and if the change happens for this particular percentage, what's gonna be the result in my NPV? So it will be like depending on different probability distributions. 10% chances are this gonna happen, 30% chances are this percent is gonna happen, 50% chances are this particular percentage is gonna happen. So that will be depending, and this is something which will be like relevant with all the simulation based techniques, okay. We'll be talking about here about this particular simulation things, okay, and that will be depending on that uncertain variables and using those values. Now what would come to me definitely, sir, why usually we take up some of the projects relating to simulation analysis, like why would someone go for simulation analysis? Absolutely guys, there is a huge demand for simulation analysis into the market, okay. People are short of time, they don't have that much time to invest, wherein they'll be like waiting for the results to happen. They already want to have a fair idea of the kind of idea uh, of a particular situation, wherein they get to know that if in case I'll be investing this particular amount in this particular project, what's going to happen. They need to know it at the initial first step itself, okay. So how and in what kind of situations is simulation analysis more likely to be worthwhile? Number one, if in case the data is like huge, okay, or if in case the amount of money at stake is huge. 1000 crores is a very big amount, okay, very big amount. So you need to know that if in case that's a large amount of money that's taking in, we need to have the simulation analysis done, okay. We just can't afford to bear that much risk, okay, for a longer period of time. So we need to have our simulation, our prototype, and all these stuff being done at the initial first phase itself. Number two will be that all the kind of complex projects which are into the market, okay, different kind of projects into the market, all these projects which are like having several interactive variables, okay, be it your sale, be it your variable cost, be it your production cost, be it your operating activities, all these things, if in case they are complex in nature, then you can have simulation analysis done so that you can ensure that everything is like on the feasible front and everything is perfect, okay, right at the beginning. Number three, when a series of similar projects, okay, you have an option to take a project one, you have another option of taking up project number two, you at the same time you also have an option of taking up project number three, okay. So when there are like series of similar projects which are likely to be analyzed and they are for risk, okay, then again you can go for simulation analysis because that's something which is going to save a lot time of yours, okay. You'll be like simply imitating something which has not happened into the real life system. And if in case lastly the company is very large, and there are like having n number of projects which require major investments to be done, again simulation analysis is something which will be like very helpful. All you need to know about simulation analysis is it is something which has not happened, okay, but it will be a very good method to implement if in case you need to imitate something relating towards the real life system as itself, okay. This is all about simulation analysis. Now, moving on to the second core part with the same topic, that is, what kind of steps will be like involved in simulation analysis. This question has already been asked in CA final examination for May 2011. Number one, you need to develop a model. At the first, prototype is being made only and only if in case you have got model in your hand. First of all, you need to develop a model. Okay, then you will decide onto the probability distribution, that what amount of sale will happen at, and what is the probability of being happening. So let's say 10,000 rupees sale will be like done in that particular year, and the probability, or I say the possibility of having done 1,000 rupees sale is just 10%. Then you say that there is a likely possibility of the sale being made for rupees 2,000 in that particular year. I simply say that the possibility is just 30% of that. Okay, then and so on and so on and so on. So you're gonna decide the probability distribution. Then you'll be calculating the cumulative probability distribution. At 1,000 that was 10%. At 2,000 that was 30%. At 3,000 it's 50 more percent. So it's gonna be 10%, 20%, and 50%. It's gonna be a total of 80%. Okay. So we'll be deciding onto the cumulative probability distribution part for each of the variable. After calculating the cumulative probability distribution, all you need to do is you just need to decide the interval. Okay, interval of that random numbers. You have actually seen up this thing in many of your database as well, be it using your Excel, be it your particular company software. They usually get like provide you some of the interval. Okay, let's say I want five figures. Okay, five random figures from the range of 0 to 100. I'll just simply insert my data into the system and I'll get to know what all five numbers are going to be available on my way. So it's going to be decided by that system itself. So you need to decide the interval for that. My interval here would be like 0 to 100. So accordingly and technically you can uh, change your interval numbers. Okay. So decide an interval for that random numbers for each of the variable. Then those random numbers will be generated. Then what's going to happen from your end? You just need to simulate a series of all the trials, all the methods that you'll be like using, and you'll be determining the stipulated value of that particular NPV on all those random numbers. And finally, you'll be plotting that frequency distribution of your NPV on your chart. So this is how simulation analysis is being done. You need to develop a model, you need to decide on the probability distribution, you need to calculate the cumulative probability distribution, decide onto the interval of the random numbers for each of the variable, generate the random numbers accordingly, stimulate a series of trials with those random numbers and determine the stimulated value of the NPV, and finally plot the frequency distribution of NPV. I hope you guys are clear with this particular steps as well. We'll be like implementing all of them in our forthcoming presentations, which will be involving my questions. I'll be concluding this video with the last topic, and that will be limitations. What all are the limitations of simulation analysis? Absolutely, guys. Number one, by now you've like already known this fact that this particular analysis measure requires a good amount of information, a lot amount of information, and it is generally just not available. Okay, in each of the scenarios that you'll get so much information. So that is one of the limitations for that. Next, interaction between variables needs to be incorporated into the analysis. We are just focusing on one variable or another variable at a time. So the interaction, be it your change in one variable, is going to be like changing another variable. These kind of interactions are usually not available in simulation analysis. So that is something which is lacking over here. It needs to be done. And finally, there is no clear decision rule which is emerging from the simulation analysis. There is no one particular rule. If I'll say that if I'll be like implementing this particular rule, I'll be getting the most appropriate answer for my analysis. That is something which is just not available. So no clear decision rule is emerging from any of the simulation analysis. All you need to do is just try for many of the options. Okay, and technically you'll be getting the best one out of the same. So these are the limitations of simulation analysis. I hope I was able to make you aware of each and every kind of concept that is revolving around this chapter. I was able to make you understand that all you need to do is just revise the topic, because that is something which is extremely crucial for each one of you guys. Don't lack on that particular stuff. Do not at all. Perfect, guys. I'll see you in the next presentation with a lot more fascinating topics, and in that particular stuff, we'll be like marking the beginning of the kind of questions that are being asked in CA final examinations. With this, I'll say thank you. On behalf of the Edupedia world, keep interacting by questions, queries, and YouTube comment boxes. I will love to answer each one of your queries and grievances. If in case you have liked our video, if in case you have find it informative, do give us a thumbs up. Do write your comments. That will help us in that will act as a morale booster for each one of us. Stay connected. That will help us in understanding our needs way better, guys. I'll see you in the next presentation with the forthcoming questions that will be like asked in CA final examinations. Till then, sayonara. God bless you all. Take care. Bye.